The yen carry trade, origins in Japan's lost decades and global spillovers. Like if you're ready to unlock the secrets of the yen carry trade and supercharge your financial savvy, share this episode with your network to spark epic discussions on global topics. Follow or subscribe for more mind-blowing insights. Don't miss out on the next big reveal. We're unpacking something that's been bubbling under the surface for decades and finally boiled over in the last couple of years. The yen carry trade. This isn't just some obscure Wall Street gimmick. It's a massive financial maneuver that's shaped economies, inflated bubbles, and recently caused some serious market chaos. Stick around as we break it down from the beginning to where we stand now in early 2026. Let's start with a little intrigue. Imagine borrowing money for basically nothing, flipping it into investments that pay way more, and watching your profits stack up year after year. Sounds like a dream, right? But what if that cheap money suddenly gets expensive, and everything starts unraveling? That's the hook here. A strategy that powered global growth for ages but turned into a nightmare when the winds shifted. We'll explore how it all began without giving away the twists yet. Now let's get into the meat of it. The yen carry trade kicked off around 1999, right after Japan slammed into a wall economically. Back in the late 1980s, Japan was on fire, stock markets and real estate were skyrocketing in what we now call the bubble economy. But by 1990, that bubble popped hard, plunging the country into recession, deflation, and what became known as the lost decades. Growth stalled, prices fell, and the Bank of Japan stepped in with aggressive moves. They slashed interest rates to near zero in a policy called ZIRP, zero interest rate policy, to encourage borrowing and spending. By the early 2000s, rates were hovering at 0% or even dipping negative, making yen loans dirt cheap. Why did this happen? On the surface, it was about jump-starting Japan's sluggish economy. Deflation was sucking the life out of everything. People delayed purchases waiting for prices to drop further. Businesses held back on investments. The Bank of Japan wanted to flood the system with easy money to reverse that. But speculatively, there's more to it. Japan aimed to weaken the yen deliberately to boost exports. A cheaper yen made Japanese goods like cars and electronics more competitive abroad, helping giants in manufacturing rack up sales. Critics argue this was a form of currency manipulation, keeping the yen undervalued to prop up trade surpluses. Some even speculate it was a quiet agreement in global finance circles, where low rates in Japan provided a funding source for riskier bets elsewhere, stabilizing markets post-Asian financial crisis in 1997. Whatever the intent, it created the perfect storm for the carry trade. Borrow yen at next to nothing, convert it to dollars or other currencies, and invest in higher-yielding assets like US bonds or emerging market stocks. For years, this hummed along smoothly. Traders borrowed in yen at rates like 0.25%, swapped it for US dollars where Treasuries yielded 4 to 5%, and pocketed the difference. If the yen depreciated, as it often did thanks to those policies, the profits got even juicier. By the mid-2000s, it was fueling global booms. In Japan, everyday folks felt mixed effects. The weak yen helped exporters, creating jobs in manufacturing hubs and keeping unemployment low. But for regular people, it meant higher costs for imported goods, think oil, food, and electronics. Inflation stayed tame overall, but wages stagnated, and many households struggled with rising living expenses while their savings earned zilch in low-rate banks. Outside Japan, the impacts were huge. Cheap yen flooded into places like Australia for real estate, the US for stocks and housing, and emerging markets like Brazil or Turkey for bonds. This inflated asset prices, making homeownership easier in some spots but creating bubbles that hurt when they burst. Normal people globally benefited from lower borrowing costs, cheaper mortgages and car loans thanks to suppressed yields, but suffered in crashes, like the 2008 financial crisis where yen carry unwinds amplified the pain, wiping out retirement savings and jobs. Fast forward to the 2020s and the trade ballooned. Estimates vary, but by 2025, narrow definitions pegged it at around $261 billion in direct positions, while broader ones including derivatives hit $1 trillion or even up to $20 trillion. Japan's debt-to-GDP ratio soared past 250%, the highest for any major economy, funded by the Bank of Japan's massive bond buying. But cracks appeared. Inflation perked up in Japan post-COVID, wages rose slightly, and the economy showed moderate recovery. The Bank of Japan started normalizing, ending negative rates in late 2023, then hiking to 0.1% range. The big shifts came in 2024. A surprise 25 basis point hike in August sent the yen surging 10% against the dollar in weeks. The Nikkei crashed 12% in a single day, and global markets buckled. US stocks lost over $1 trillion in value briefly. The unwinding accelerated into 2025 to 2026. Another hike in December 2025 pushed rates to 0.75%, the highest since 1995. Japan's 10-year government bond yield hit a 25-year high of 2.5% by late 2025, and 30 to 40-year yields topped 4%. The Bank of Japan sped up quantitative tightening, shedding 61.2 trillion yen, $407 billion, in assets by end 2025, down 8.1% to 695 trillion yen, $4.62 trillion. Political moves amplified it. Prime Minister Sonai Takaichi's $135 billion stimulus and sales tax suspension signaled more spending, eroding investor confidence. Yields surged as bond auctions saw weak demand, with bid-to-cover ratios dropping below averages. What does unwinding look like? As a chain reaction. As rates rose, the interest differential shrank. Borrowing yen at 0.75% versus US yields at 4 to 5% became less appealing. The yen strengthened from around 157 to 153 against the dollar in hours after hikes, then hovered at 140 to 150 by 2026. Traders rushed to repay yen loans, selling foreign assets to buy back yen, which further appreciated it. In 2024's episode, the Mexican peso, Brazilian real, and Turkish lira weakened sharply. Globally, emerging markets flashed warnings. Capital outflows triggered sell-offs. In 2025, the S&P 500 dipped 2%, wiping out trillions, and tech stocks suffered as leveraged positions unwound. By early 2026, forecasts see the yen at 147 to 160 per dollar, but risks of further hikes to 1 to 1.5% by year-end could unwind more. The effects on normal people now are stark. In Japan, higher yields balloon debt servicing. Already 23% of tax revenue goes to interest, and with 250% debt to GDP, even small hikes tip toward crisis. Everyday folks face pricier loans for homes or cars, potential budget cuts in services, and if the Bank of Japan prints more, inflation erodes savings. Exporters like auto workers hurt from a stronger yen, making goods less competitive, risking layoffs. Outside Japan, the unwind ripples far. U.S. homeowners see mortgage rates climb as Japanese investors repatriate from $1.2 trillion in treasuries, pushing 30-year yields to 4.9%. Retirement accounts take hits. Think 401ks down amid stock volatility. In emerging markets, currency slides mean higher import costs for food and fuel, squeezing households. Globally, fixed-income retirees suffer as bond values drop and inflation bites. Who gets hit hardest? Retail investors with stock exposure, without hedges. Emerging market residents facing devaluations, and overleveraged households in high-debt economies. Banks and high-debt companies amplify the pain through job losses. Diving deeper into the themes, this whole saga highlights how interconnected global finance is. What started as a Japanese policy fix became a pillar of worldwide liquidity, but it bred fragility. Low rates encouraged risk-taking, inflating everything from crypto to real estate, but unwinds expose the illusion easy money isn't free forever. Speculatively, it raises questions about central bank overreach. Did propping up the yen trade delay necessary reforms in Japan, like structural changes to boost productivity? Globally, it fueled inequality. Big institutions profited while crashes disproportionately hurt the average person. In the unwind phase, we're seeing a regime shift. Japan tightening while others cut rates flips flows, potentially sparking more volatility. Risks like geopolitical shocks could turn it into a full-blown crisis, but gradual hikes might allow orderly adjustments. A few standout lines from the fray capture the essence. One analyst noted, "The yen carry trade is just $261 billion, not trillions. Unwinding is gradual, but risks remain if the Bank of Japan goes neutral in 2026. Another from financial circles warned, a deeper route in global markets could unwind yen carry trades and restore the currency's safe haven status. And reflecting on the start, an early observer said, the historically high yen carry positions, fueled by interest rate gaps and risk appetite, may unwind and amplify market volatility. Wrapping this up, the yen carry trade story is a cautionary tale of easy money's double edge. Powered wins for decades but now leaves losses in its wake. If you're navigating finances today, consider diversifying. Look at safe havens like gold or defensive stocks to weather the storm. Stay calm, stay prepared, stay free.